Are you a podcaster? Maybe you've got that big idea and you're looking for a network to join. The multi-award-winning Ozcast Network can get your content to eyes and ears all over the world. Join now for the first month free, and you could be featuring this sound at the beginning of your podcast.
Ozcast.
Simply head to ozcastnetwork.com for details.
The information contained within this podcast does not consider your personal circumstances and is of a general nature only. You should not act on it without first obtaining professional financial advice specific to your circumstances.
Paul Atherton is an ex-Wall Street advisor on a mission to help young people win back their financial power, wealth and security. He does this by helping them understand the hidden world of finance, risk and investments, helps them figure out how it impacts them, and to seize the opportunities to make it work to their advantage. This is Paul Street Journal. I'm here today with Paul Atherton. How are you, Paul?
Hi, Tim. I'm doing really well.
That's good. So I'm just wondering, I'm 22, I want to kind of perhaps retire as soon as possible. It sounds good. I know I've only been working for 4 years, but hey, that's long enough, I feel. I'm wondering what I could do to set myself up in 30 years' time.
Wow. Well, partly would be to keep working, Tim. So. Don't give up just yet. Yeah.
Well, not the answer I was hoping for.
Oh, well. Wow. Yeah, so that's a good question. I mean, set yourself up. I think, well, what do we often get? I want to do some sensible things now. I think the vast majority of people who I talk to are the younger generation, such as yourself, who go, I don't need to be multi-millionaires. I just want to make sure I'm doing the right thing now. Because everybody tells me you start early, things end up well. But that's only really a little bit of the story. So what should I be doing? So yes, okay, you're lucky you're young, but what should I be doing? So let's take that question, set yourself up for 30 years' time. To me, it's not like just a question of where to invest. So there are three aspects. It says when to invest, how much to invest, and of course, where to invest. So let's sort of unpack those a little bit. Let's talk about how to invest. Now, if you have a little bit of money, what the worst way to do it would be to just place it immediately on the market, okay? Or, which the alternative is get a little bit scared and go, oh my gosh, the market seems high, or I think it's going to crash, so I'm not going to put anything in the market, and you just start slowly building up a lot of cash. And as most investment experts will tell you, cash is the worst investment. Now, I don't mind cash, by the way, for a little bit of patience, so I think that's a good trade, but if it's not a good investment strategy. Now, the problem is you're still hoarding cash and you're not putting it in because you're a bit nervous. What you're really doing is you're trying to market time, implicitly or not. Implicitly or explicitly. So what it is suggested, which is really, really the best thing to do, is not say I can time the market. And trust me, being in this game for a long time, market timing is impossible. Like, I've never seen anybody do it. It's equivalent to saying, can you predict the future? And that's very, very difficult to predict the future. Nigh on impossible. So what should you do as an average investor? Well, the best thing to do is what they call dollar cost averaging. So you need to start drip feeding your money into an investment. And we'll talk about what to invest in a second, or what are some options. But so drip feeding it in a small amount of time on a weekly basis. Now, what this means is, if you're hoarding the cash and you're trying to predict the market, you're far more likely to invest at a high and then sell at a low, because you're going to get overexcited about the market and they'll get very scared. So you don't want to be that person. But when you're dollar cost averaging, you're going to get slowly the average of the market. So you'll get the average accumulation. And that means you won't get the highs, but you won't get the lows either. Or I should say, you won't pick the lows, but you won't pick the highs either. In other words, you'll get some averaging over that period of time. And that is just absolutely fine. And that means your returns, they won't be the best that you can get. Okay, so if you could look back over the last 20 years and just pick exactly the perfect points, your returns would be madly positive. But you can't be that person. So in light of that, you just slowly drip feed it over the period of time. Because one thing you do know, over any extended period of time, history has told us again and again that the stock market goes up. Because that's what we do. We as countries, as individuals and as communities and as countries, we progress. We go forward, we have positive GDPs most of the time, and the country, the economy expands, and then your investments expand with it, hopefully, if you've particularly if you've chosen a broader index. So participate is the right way. Participate over a longer period of time and drip feed in those accounts. So that's how to invest, dollar cost averaging. So the question is how much to invest. And I guess that's a very individual thing to me, but there are certain ways to think about it. So you can't put too much in that it causes you pain. So if it's causing you day-to-day pain, then that might be an issue. And if it's causing you so little, if you're putting so little you don't even notice it, well, that's good because you're going to keep investing. But there's got to be some equilibrium point. Not too much, Goldilocks. Not too much, not too little, not too much. And what that generally comes to me is about, from your wage, about 10 to 15%. And it shouldn't be too much less and it shouldn't be too much more. So around that page. Now, interestingly, well, that's just about where your superannuation is. But your superannuation, remember, is being placed in there by your employer. So I would strongly suggest to yourself and to listeners, if it's not too painful, if it doesn't cause you any day-to-day cash problems or cash flow problems, doesn't cause you any issues, to start thinking about topping up your superannuation. And there are ways to do that in a very tax-efficient way and increase that amount. Do that on a regular basis. Hopefully you can do it on a weekly, maybe monthly basis from your income straight into an investment account. Do it for 30 years and you're going to be absolutely fine. More than fine. You'll be incredibly well off. I mean, most people will. That's just the law of large numbers will be on your side. Okay, so in the third and the last is where to invest. So let's look at the last 20 years. And I think from 1996 to 2016, a nice 20-year period, and I've run some numbers on this. If you put down what the median house price then was back in 1996, ladies and gentlemen, was $144,000, around $144,000. Can you imagine that in 1996? That's just amazing. Now, in 2016, what do you think the median house price was, Tim? Give it a guess.
I'm going to 600,000?
Yeah, 623,000.
Wow. Crazy.
You'll find areas that are much larger than this, and you'll find areas that haven't quite got there, but that's not too shabby, right? That's a 330+% return, 330% return, or 479,000 you've made on your investment. Wow, how awesome! So that's pretty good. So now let's say you took the same amount of money and you didn't put it on a house, but you put it in the stock market. Now, so if you put $144,000 in 1996, now today that $144,000 in the ASX 200, so the Australian stock market, what do you think that would be worth today, Tim? Give that a guess, more or less.
I mean, the public conception surely is, maybe what you've tripled your money over 20 years. So
yeah,
maybe
if
500.
I asked, I think the most people would say it would be below property, and that property's done better. That would be incorrect. So your portfolio would be worth $822,000 or 471% profit.
Wow.
With a $678,000 return over 20 years.
So you could actually just buy the house that you wanted to get 20 years ago and still have money left over.
And then you could, you would. That's a good way of putting it. You could buy a $200,000 car plus the property.
Yeah.
Now, there are little nuances to this before we get very excited. So first of all, on the positives, the pros, the great thing about stocks and what I love stocks is they're incredibly liquid. You can sell them anytime. Liquid means that it's very easy to turn into cash. That's essentially what liquidity means. That's what us finance guys talk about. How liquid is it? How quick can you turn this into cash and realize the cash and put it into your bank account? Now, we know when you're selling a house, particularly if it's a bit of a sticky market, how long does it take to sell your house? Well, gosh, it could take many, many months. 6 months? 3 months? I don't know.
And it's stressful, especially if you bought another property and it's dependent on you selling your property.
And then we talk about the chain. It's just a nightmare. Well, I don't know. Maybe it isn't a nightmare, but let's just say it takes time. And stocks could be literally instantaneously.
Yeah.
Right. So we're talking minutes. Maybe for $800,000, it might take a couple of minutes. I don't know. But the point being, it won't take long. And it really won't take long. I mean, the depth of the ASX is quite considerable. So that would put a little tick in the pro stocks camp. But what about the pro houses camp? See, what people forget about when on my finance side, and the guy's always saying, stocks always outperform houses. Well, what you forget, in housing, you've got leverage. You see, you didn't put $140,000 on that house, did you? Not really. Not likely. You probably put $30,000 down. And now your returns are much bigger, particularly if the low rates, right? Low interest rates. So now your returns are much better. So leverage makes a difference. And I would tell people, by the way, don't think that you should then go in and leverage your stocks, because you'll never get that advice from me. Quite the opposite. Leveraging, particularly in stocks, is such a dangerous game. So you're implicit. You have leverage. You have control over a larger amount of money with a small amount of money. You have a large cash mortgage with a small amount of cash down.
But if we put that in context though, right, if you had bought the house in 1996,
Yes.
the interest rates then would have been quite high.
Yes, well then puts another thing back into the pro stock camp, which is, yes, but you've just paid interest rates for all of that period. For 20 years, you paid interest rates. So if you didn't buy it outright, you've been paying more, right? So you know, I don't know if anybody's done this. We should do a little bit of a expose on this. But how much you end up paying for your house is more than that cost of your house, clearly. And when you're paying high interest, when you first get a mortgage, it's almost all interest. So the principal doesn't start coming off towards the end, right? So it's interest payments. So an interest payments is equivalent of throwing money out the door while giving it to the bank. And, you know, I don't know about you. I don't like going to the bank and giving them my money. So once that's taken into account, that really puts the tick back into the pro stock group. So if you wanted to do an apples to apples, it's a little bit more complex comparison than just perhaps that. So you should run numbers.
Yeah, multivariate analysis.
Well, the thing is think about it, right? You've got to live somewhere.
Yeah.
So you have a house.
Yeah.
And that should be your investment. Now look at that should be your housing investment. Unless you're in that business. If that's your business and you're running a business, that's a different game. But investing, like anybody can be in the investing game. Anybody can invest on the ASX without knowing what the companies are. You just know that, you know, that over any 20-year period of time, any 10-year period of time, stocks increase in value.
It's just that asset liability argument, I guess.
Yes.
Between whether your house is an asset or a liability.
Yes, indeed.
Anyway, thank you for coming in today, Paul.
Cheers, Tim. Thank you.
Paul Street Journal.
Are you a podcaster? Maybe you've got that big idea and you're looking for a network to join. The multi-award-winning Ozcast network can get your content to eyes and ears all over the world. Join now for the first month free, and you could be featuring this sound at the beginning of your podcast.
Ozcast.
Simply head to ozcastnetwork.com for details.